Last week, the global financial markets witnessed something truly historic. Silver, the metal often called the gold of the poor, surged to a staggering $84 per ounce. For those who have followed this market for decades, that number was not just a price point, it was a psychological breakthrough. When you adjust for inflation, $84 represents a level we have not seen in 45 years. The atmosphere among investors was electric. Many believed we were finally seeing the true value of silver reflected on the charts, driven by a massive supply deficit and the insatiable hunger of the green energy revolution. But as the sun rose this Monday, December 29th, 2025, the euphoria evaporated in an instant. If you were watching the silver tickers today, you saw a sea of red. In a matter of mere hours, silver plummeted, dropping over 5% in a single session. Significant portions of hard-earned gains vanished. For the retail investor sitting at home, it looked like a total collapse of demand. It looked like the dream of triple-digit silver had died. However, if you look closer at the machinery of the global markets, you will find that nothing fundamentally changed about the metal itself. The world did not suddenly stop needing silver for solar panels. No massive new silver mine was discovered overnight. The demand from the artificial intelligence sector did not vanish between Friday and Monday. Instead, what happened today was a clinical, mechanical, and highly effective intervention in the paper market. The silver price did not fall because people stopped wanting to own it. It fell because a specific group of people were suddenly told they were no longer allowed to hold their positions unless they could produce billions of dollars in cash immediately. This was not a shift in investor sentiment. It was a forced liquidation triggered by a rule change that took effect this morning. In this deep dive, we are going to peel back the layers of what really happened on the Comex exchange today. We will examine advisory number 25393 from the CME Group. We will look at why a 25% increase in margin requirements acts like a financial guillotine for small and medium-sized traders. More importantly, we will place this event in a historical context that spans back to 1980 and 2011. You are about to see a recurring pattern in the financial world. Every time silver threatens to break the systemic boundaries of the traditional fiat system, the rules of the game are changed midstream. This is a story of power, leverage, and the eternal struggle between the physical reality of a scarce metal and the infinite complexity of paper contracts. By the end of this video, you will understand why today was not a market failure, but a market feature. We are entering a period of extreme volatility, and understanding these mechanics is the only way to survive the coming storm. To understand the sudden carnage in the silver market, we must look at the official documents issued by the gatekeepers of the exchange. On December 26th, while most of the world was distracted by the holiday season, the CME Group released a critical document. It was advisory number 25393. To a casual observer, it looked like a routine administrative update. But to professional commodity traders, it was a declaration of war on long positions. The announcement stated that effective today, Monday, December 29th, the initial margin requirement for March 2026 silver contracts would be raised to $25,000 per contract. To put that in perspective, only 2 weeks ago on December 12th, that same requirement was $20,000. This represents a 25% increase in the amount of collateral a trader must maintain just to keep their position open. Now, why does this matter so much? In the world of futures trading, most participants do not pay the full price of the silver they are betting on. Instead, they use leverage. They put up a small fraction of the total value, known as margin, to control a much larger amount of the metal. When the CME Group decides to hike these requirements by 25% in such a short window, they are effectively shrinking the buying power of every single participant in the market. Imagine a fund or a retail trader holding 100 contracts of silver. Suddenly, they are told they need an additional $5,000 per contract just to stay in the game. For 100 contracts, that is an immediate demand for $500,000 in cash. This is the invisible hand of the exchange. By changing the margin rules, the CME can force participants to exit their trades, regardless of whether those traders still believe the price of silver will go up. The timing of this advisory is also worth noting. It was released right at the end of the year, during a period of low liquidity, when many banks and wire transfer services are operating on holiday schedules. This makes it incredibly difficult for traders to move large sums of capital into their brokerage accounts to meet these new requirements. When a trader cannot produce the cash, the broker does not wait. They are legally obligated to liquidate the position immediately to protect the clearinghouse. The CME Group officially states that these moves are necessary for risk management. They argue that when volatility increases, the exchange must ensure that all participants have enough skin in the game to cover potential losses. This is a logical and reasonable explanation from a regulatory standpoint. High volatility creates systemic risk, and higher margins act as a safety buffer. However, we must ask ourselves a deeper question. Why does this buffer always seem to expand most aggressively when the price of silver is in a vertical rally? When silver was stagnant for years, margin requirements were low and stable. But the moment it touched $84, the rules were tightened twice in 14 days. This mechanical pressure creates a ceiling on the price that has nothing to do with how much silver is actually available in the world. It is the power of the paper market to dictate terms to the physical world. To truly grasp the devastation we saw today, we must understand the mechanics of a margin call. It is the most feared phrase in the world of professional trading. To make this clear, let us use a simple analogy. Imagine you decide to buy a house worth $1 million. The bank requires a down payment of 20%, which is $200,000. You pay that amount, and you now control the property. But imagine if one morning, the bank calls you and says the rules have changed. They now require a 50% down payment due to market volatility. They demand an additional $300,000 in cash by the end of the business day. If you do not have that cash sitting in your bank account ready to be transferred, the bank does not simply talk to you about it. They take your keys, put the house on the market, and sell it at whatever price they can get just to cover their own risk. This is exactly what happened to thousands of silver traders this morning. When advisory number 25393 took effect, the margin requirements jumped to $25,000 per contract. For many smaller hedge funds and retail investors who were already stretched thin by the rapid rise to $84, this was the breaking point. When a margin call is triggered, it creates a chain reaction. Because the banks and wire transfer systems were slow over the holiday weekend, many traders found themselves trapped. They had the wealth on paper, but they did not have the liquid cash in their accounts. When the deadline passed at the market open, brokers began the process of forced liquidation. Here is the most important part to understand about forced liquidation. A broker who is closing a position because of a margin call does not care about getting a good price for the client. They do not wait for a bounce. They sell at the market price immediately. When thousands of these orders hit the system at the same time, it creates a massive wave of selling pressure that has no buyers on the other side. The data from today is shocking. In just 15 minutes during the peak of the sell-off, over 13,000 contracts changed hands. To put that into perspective, that represents 67 million ounces of paper silver sold in a quarter of an hour. That is equivalent to 2 months of global silver mine production dumped into the market in the time it takes to drink a cup of coffee. This is why the price looks like a straight line down on the charts. Normal selling looks like a staircase, with buyers stepping in at lower levels, but forced liquidation looks like an elevator with the cable cut. The sellers are not selling because they want to. They are selling because they are being forced to by the very rules of the exchange. This mechanical selling drives the price down, which then triggers even more margin calls for other traders, creating a cascading effect. By the time the dust settled today, silver had been pushed down more than 10% from its recent highs. This was not a change in fundamental value. This was a clinical liquidation of leverage. To understand if today was an anomaly or a deliberate strategy, we must travel back to one of the most famous episodes in financial history. The year was 1980. The characters were Nelson Bunker Hunt and William Herbert Hunt, the sons of a legendary Texas oil tycoon. They did not just want to trade silver, they wanted to own it all. The Hunt brothers believed that with high inflation and a weakening dollar, silver was the only true refuge for wealth. Over several years, the brothers and their associates accumulated an estimated 200 million ounces of silver. At the time, that represented roughly 1/3 of the entire world supply outside of government vaults. They were not just buying paper contracts. They were taking physical delivery and moving the metal to private vaults in Switzerland. This massive accumulation created a historic squeeze. Silver prices exploded from around $6 in early 1979 to a peak of $48.70 in January 1980. The establishment was panicked. The rapid rise in silver threatened to collapse the industrial users who needed the metal and embarrass the central banks. Something had to be done. That something was not a change in supply or demand. It was a change in the rules. On January 7th, 1980, the Comex introduced what became known as Silver Rule 7. Silver Rule 7 was a game changer. It effectively prohibited the opening of new long positions in silver. Traders were only allowed to sell to close their existing positions. At the same time, the exchange hiked margin requirements to unprecedented levels. This was a direct strike at the Hunt brothers, who had borrowed heavily to finance their massive hoard. The impact was immediate and brutal. Without new buyers allowed into the market, and with existing holders forced to come up with millions in cash to meet margin calls, the price had nowhere to go but down. The climax occurred on March 27, 1980, a day now remembered as Silver Thursday. The Hunt brothers missed a massive margin call of $100 million. Silver plummeted from $21 to below $11 in a single day. The brothers lost over $1 billion and were eventually forced into bankruptcy. Years later, a jury found them guilty of conspiring to manipulate the market. But for many independent observers, the real manipulation was the sudden change of rules by the exchange. The lesson from 1980 is clear. When the price of silver rises too fast and threatens the status quo, the gatekeepers have the power to change the rules of the game overnight. What we saw today with advisory number 25393 carries the same DNA as Silver Rule 7. It is the use of administrative power to achieve what the market could not do on its own. The ghost of 1980 returned to haunt the silver market 31 years later. In the aftermath of the global financial crisis of 2008, the Federal Reserve began a massive experiment called quantitative easing. They flooded the system with trillions of dollars and pushed interest rates to zero. For investors worried about currency debasement, silver became the ultimate weapon of protection. Between 2008 and 2011, silver staged a magnificent rally. It climbed from a low of $8.50 to nearly $50 an ounce by April 2011. This move was not driven by two brothers in Texas. It was driven by millions of investors worldwide who lost faith in paper money. But once again, as silver approached its all-time high, the invisible hand of the exchange reached out to stop the momentum. In late April and early May of 2011, the CME Group did something extraordinary. They did not just raise margins once. They raised them 5 separate times in a span of only 9 trading days. Think about the psychological and financial pressure that creates. Every time a trader adjusted their account and thought they were safe, the exchange moved the goalposts again. By the end of those 9 days, the amount of cash required to hold a silver contract had effectively doubled. The result was a textbook case of cascading margin calls. Forced liquidation swept through the market like a wildfire. Silver, which had been flirting with $50, crashed nearly 30% in the following weeks. The rally was broken, not by a surplus of silver, but by a deficit of available cash among the traders. The official explanation in 2011 was the same as it is today. The exchange claimed they were managing extraordinary volatility to protect the system. While that may be true from a technical perspective, the timing was surgically precise. Each margin hike occurred as silver was testing key resistance levels. This brings us back to our current situation in December 2025. When we look at the timeline, we see the same pattern. Silver breaks $80. The first margin hike arrives on December 12th. Silver continues to show strength. Then, the second and more aggressive hike arrives on December 29th. History shows us that these interventions are highly effective at cooling off a hot market. They flush out the leveraged players and create a window of opportunity for short sellers to cover their positions at lower prices. In both 1980 and 2011, these rule changes marked the end of the vertical phase of the rally. However, there is one major difference in 2025 that we must address. In previous cycles, the silver market was dominated by speculators. Today, it is driven by a structural industrial deficit that paper rules cannot fix. The question is, will the old playbook work when the world is actually running out of the metal? While the digital tickers on Wall Street were flashing red today, something very different was happening in the real world. This is what analysts call the Great Disconnect. If silver was truly worth 5% less today than it was on Friday, you would expect every dealer in the world to be lowering their prices to attract buyers. But that is not what happened. As the paper price plummeted on the Comex, I performed a real-time check of the largest physical bullion dealers in the United States. I looked at JM Bullion, APMEX, and SD Bullion. The results were fascinating. For a 1-ounce Silver Eagle coin, the price did not drop in line with the spot price. In fact, in many cases, the total price to buy an actual ounce of silver stayed exactly the same as it was before the crash. Why is this? It is because of the premium overspot. Dealers noticed the paper sell-off was driven by margin changes, not by a lack of buyers. They knew that a lower paper price would actually trigger a wave of buying from people looking for a bargain. To protect their limited inventory, these dealers simply raise their premiums. If the paper price goes down by $2, but the dealer raises their premium by $2, the price for the physical metal remains unchanged. This proves that the paper market and the physical market are currently two different universes. The paper market is a place of high-frequency trading, extreme leverage, and administrative rule changes. It is where banks and hedge funds trade digital promises of silver. The physical market is where real metal moves from mines to factories and into the hands of long-term investors. We must understand that for every ounce of silver sitting in an exchange vault, there are hundreds of ounces of paper claims circulating in the financial system. This is a highly leveraged structure. When the CME raises margins, They are attacking the leverage in the paper market. They are not affecting the physical metal at all. In fact, today's drop might actually make the physical shortage worse. When the paper price is pushed down artificially, industrial users and savvy investors rush in to buy the physical metal at what they perceive to be a discount. This leads to a massive drain on exchange inventories. Since October of this year, over 53 million ounces of silver have been moved out of the Comex registered category. This means the metal is being moved into private hands where it is no longer available for delivery against paper contracts. If you are an investor holding physical coins or bars in your safe, today's price action was a phantom move. Your ounces did not change. Their industrial utility did not change. The only thing that changed was the perceived value of a paper contract on a screen in Chicago. Understanding this disconnect is the key to maintaining a calm perspective during periods of high volatility. The paper market may set the daily price, but the physical market will eventually determine the ultimate value. Despite the turbulence in the paper markets, the fundamental reason to own silver has never been stronger. We must look beyond the trading screens and examine the industrial heart of the global economy. Silver is not just a financial asset. It is an indispensable industrial metal with unique physical properties. It has the highest electrical and thermal conductivity of any element on Earth. In the modern world, if it has an on and off switch, it likely contains silver. Let us look at the solar industry. This sector has moved from a niche market to a global powerhouse. According to data from the Silver Institute, photovoltaic applications consumed approximately 230 million ounces of silver in 2024. Projections for the near future suggest this demand will exceed 300 million ounces annually by 2030. Every solar panel requires about 20 grams of silver in the form of conductive paste. While engineers have tried to substitute silver with copper or aluminum to save costs, they have largely failed. Silver provides a level of efficiency and durability that cheaper metals simply cannot match. Then, we have the automotive revolution. A traditional internal combustion engine car uses between 15 and 28 grams of silver. However, a battery electric vehicle requires between 25 and 50 grams. That is roughly double the silver content for every car that rolls off the assembly line. Silver is used in battery management systems, power electronics, and the massive charging infrastructure being built across the globe. As EV adoption continues to climb, the automotive sector is becoming a massive, price-insensitive buyer of silver. But perhaps the most exciting new driver of demand is the explosion of artificial intelligence. AI workloads require massive data center capacity. These data centers are filled with high-performance servers, specialized chips, and complex connectors. The thermal and electrical conductivity of silver makes it the metal of choice for these high-stress electronic environments. As companies like NVIDIA and Microsoft race to build out the global AI infrastructure, they are indirectly consuming vast amounts of silver. The total global supply of silver is currently about 1 billion ounces per year. Yet, industrial demand alone is swallowing an ever-increasing share of that total. When you add in the demand for jewelry and investment, we have been in a structural supply deficit for 5 consecutive years. In 2024, the world used approximately 1,300 million ounces of silver, but only produced 1 billion ounces. That gap of 300 million ounces had to be filled by drawing down existing stockpiles. This is why today's margin hike is so interesting. It can suppress the price of paper contracts, but it cannot create more silver for solar panels or AI servers. The industrial engine of the world is running on a metal that is becoming increasingly scarce. While traders on the Comex are worried about their margin requirements, factory managers in Asia and Europe are worried about where their next shipment of physical metal will come from. This fundamental tension is the reason why any paper-driven price drop is likely to be met with aggressive physical buying. While the Western world focuses on margin calls and paper trading rules in Chicago, a much more significant shift is occurring in the East. Specifically, we must look at China. For decades, China has been the center of the global silver supply chain. They are not only a major producer, but they also control a massive portion of the world's silver refining capacity. However, as of January 1st, 2026, which is just 3 days from today, the rules of global silver trade are about to change forever. The Chinese government has announced new export licensing requirements for silver. Under this new framework, only a select group of companies that meet strict production and financial thresholds will be allowed to export silver from the country. This is not a minor administrative change. It is a strategic pivot. By implementing these restrictions, China is effectively tightening the valve on the global silver supply. Why would China do this now? The answer lies in the industrial demand we discussed earlier. China dominates the world's solar panel manufacturing and electric vehicle production. They have realized that silver is a strategic resource essential for their domestic technological supremacy. By restricting exports, they are ensuring that their own factories have a guaranteed supply of silver at stable prices, while the rest of the world is left to compete for what remains. This creates a massive problem for Western markets. If silver exports from China decrease significantly, the supply deficit in London and New York will shift from a concern to a crisis. We are already seeing the early signs of this stress. The Shanghai Futures Exchange has recently shown silver trading at a significant premium compared to the prices on the Comex. This price gap indicates that physical metal is much harder to find in Asia than the paper price in America suggests. Furthermore, China's only silver fund, the UBS SDIC Silver Futures Fund, recently had to halt new retail inflows because the demand was so overwhelming that the price surged far above the value of the underlying assets. The Chinese people are rushing to own silver because they see the same fundamental shortage that we are discussing. When you combine the CME margin hikes in the West with the Chinese export restrictions in the East, you see two very different forces at work. The West is trying to cool down the market by attacking leverage and paper contracts. The East is protecting its physical supply because it knows the true value of the metal in the coming decades. If China continues to withhold silver from the global market to feed its own AI and green energy industries, no amount of margin increases in Chicago will be able to stop the ultimate price appreciation. The paper market can only manipulate the price as long as there is enough physical metal to keep the illusion alive. With China pulling its silver off the global stage, that illusion is starting to crack. The final 3 days of this year may be the last time we see silver freely flowing through the traditional global supply chains before the new restrictions take hold. Whenever we see a massive price drop triggered by a rule change, a single question dominates the conversation. Is this legitimate risk management, or is it market manipulation? To answer this, we must look at who benefits from a sudden crash in the silver price. In the official world of the CME Group, the explanation is simple and transparent. They are an exchange. Their primary job is to ensure that the system does not collapse. When the price of silver moves from $31 to $84 in a single year, the volatility becomes extreme. If a major trader defaults on a massive position, it could threaten the stability of the entire clearinghouse. By raising margins, the CME is essentially asking traders to prove they have the capital to handle the heat. From this perspective, today's action was a responsible move to protect the integrity of the financial system. However, there is another side to the story that is frequently discussed in the halls of institutional finance. To understand it, we must look at the Commitment of Traders Report, or the COT. This report shows us the net positions of different groups in the market. Historically, commercial traders, which include some of the world's largest bullion banks, have held massive short positions in silver. Being short means they profit when the price goes down and lose money when the price goes up. As silver approached $84 last week, these commercial short positions were facing billions of dollars in losses. In the world of high-stakes finance, this is known as being caught in a short squeeze. If the price had continued to climb toward $100, some of these institutions might have faced a systemic crisis. Now, consider the impact of advisory number 25393. By raising the margin requirement to $25,000 right at the peak of the rally, the exchange triggered a wave of forced selling. This forced selling pushed the price down over 10% in a single day. For the large banks holding short positions, this crash was a gift. It allowed them to close out their losing positions or manage their risk at much more favorable prices. The timing of these interventions has led many to believe that the exchange and the large commercial banks operate in a symbiotic relationship. When the smart money is on the wrong side of a trade, the rules are tightened to flush out the weak hands of the retail and speculative community. This is why many veteran investors describe the silver market as a rigged game. Whether you believe this is intentional manipulation or simply the mechanical reality of risk management depends on your perspective. But the data remains the same. A 25% margin hike in 2 weeks is a violent intervention. It effectively acts as a circuit breaker that protects the largest players from a parabolic price move. While the exchange claims to be protecting the market from default, the result is that the natural process of price discovery is interrupted. For the long-term investor, the lesson is clear. The paper market is not a fair fight. It is a controlled environment where the house always has the power to change the rules when the stakes get too high. As we look toward the final days of 2025 and the beginning of 2026, the silver market stands at a critical crossroads. Today's price drop was violent, mechanical, and painful for many. But in the grand theater of global finance, it is merely a single scene. The path ahead will be defined by the collision between paper market restrictions and the undeniable reality of physical scarcity. In the short term, we must watch the $70 level very closely. This is a psychologically significant round number and represents a key technical support area where silver traded before its recent vertical acceleration. If the price can stabilize around $70 despite the higher margin requirements, it will be a sign of incredible underlying strength. It will prove that even with the rules rigged against them, buyers are still willing to step in and absorb every ounce of silver available. However, we must also be prepared for the possibility of more margin hikes. If silver attempts to rally back toward $84 too quickly, the CME Group may intervene a third or even a fourth time. This is the lesson from 2011. Never underestimate the willingness of an exchange to move the goalposts to cool down a hot market. For those of you trading with leverage, your priority must be survival. Position sizing is the only shield you have against the invisible hand of rule changes. If your position is so large that a 10% drop forces you out, you are not investing. You are gambling in a house where the dealer controls the deck. For the long-term physical investor, the strategy remains unchanged. The industrial engine we discussed, the solar panels, the electric vehicles, and the massive AI data centers does not care about margin requirements in Chicago. The export restrictions from China, starting in just 3 days, will continue to drain global inventories regardless of what the paper price says. We are moving into a world where having the physical metal in your possession is the only way to bypass the manipulation of the paper markets. The silver market is not for the faint of heart. It is a market that tests your conviction and your patience. But history shows that short-term forced selling often looks poorly timed in hindsight. The participants who exited silver during the margin squeeze of 2011 missed the long consolidation that led to the historic $84 peak of today. Do not let emotion drive your decisions. Do not let a mechanical sell-off blind you to the fundamental reality that we are running out of silver. As we close this analysis, remember that stay informed is your best defense. We will continue to monitor the delivery numbers from the Comex and the impact of the Chinese export ban as it takes effect on January 1st. The new year is shaping up to be one of the most volatile and consequential periods for precious metals in history. Thank you for joining me for this deep dive. If you found this analysis helpful and want to stay ahead of the curve in these chaotic markets, please like this video and subscribe to the channel. We are committed to bringing you the logic and the data that the mainstream media often ignores. Share your thoughts in the comments below. Do you believe this was risk management or a deliberate trap? I look forward to reading your perspectives. Stay rational, stay disciplined, and I will see you in the next update.